everyone. I'm super excited that we've got Jeff Currie with us as a guest author. Hopefully, this is going to be the first of many that we get to sit down, talk about issues, and converse going forward. Everybody knows who Jeff is. I don't think, Jeff, you need an introduction. Jeff was synonymous with commodities and Goldman Sachs for decades. But I do think it's worth talking about what you're doing now, which is you're Chief Strategy Officer at Energy Pathways at Carlyle. So before we dive into the meat of commodity markets, which is your bread and butter, tell me a little bit about what's this new role?
Great. Well, thank you, Amrita. It's a pleasure to be here. I've admired your work over the decades from point when we were adversaries between Goldman
Yes.
and Barclays well over a decade ago. So it's an honor and a privilege to be here. What am I doing in my new role at Carlyle? Let's start with the energy transition. I like to point out it's nothing short of chaotic and disorganized. And one of the key reasons for that is the focus only on green at the expense of brown. And why do we use the word energy pathways? Because ultimately it's about those pathways between the brown and the green. And you've got to manage the winding down of the brown. It still represents 82% of primary energy, still feeds 8 billion people, and creates the pillars to modern society, things like cement, plastic, steel, ammonia. Our view here is to focus on both the brown and the green and the potential pathways between the two. And, the saying I like to say is, you cannot control the emissions unless you own the emissions. And so that's why we want to include brown in the portfolio. And so that's really the focus of what we're trying to do.
It's super exciting. It's funny because I was in Norway yesterday, without naming names, but you can figure out who in Norway, right? There's not that many. But again, speaking at their board meeting and so on, I think there is a genuine realization now about how you need to own the brown. And it's about decarbonizing that hydrocarbon chain rather than just saying it has to be all green. So I think it is the right time for this, Carlyle to kind of look into this, because it's very nascent, but I can absolutely see the trend in the market going that way, that, okay, it's no longer about just the green. So
exactly. So exciting.
Okay, but look, let me ask you the questions I'm sure everybody else wants me to ask you, which is, are you still bullish oil given that everybody else is pretty bearish?
Absolutely, yes. But I think when we think about it on a longer term basis, we've had some setbacks in 2Q. Remember, we're in the shoulder months. This is the weakest part for oil. But let's look at the rest of the commodity complex. It is telling you that the super cycle thesis is very much underway right now. And when we think about commodities, it still depends on what day you measure it, but it's up there with the top performing asset classes across all the different financial markets because of the fact that you have an environment that cyclically supports commodities, but there's also that structural story. And I think everything that happened in copper that we saw last week is an indication of that story. You think about the structural drivers of demand, just kind of going back to our super cycle thesis. The way we like, to define it is redlining oil demand, RED, redistributional policies, environmental policies, and deglobalization. And copper is the poster child of that. Particularly look at what's driving copper more recently, whether if it is green CapEx demand in China, green CapEx demand in the US and Europe, which, by the way, that's stimulus. That impacts oil demand. It just takes a little bit longer. Then AI demand. Let's don't underestimate you're going to see a doubling in power generation demand. I don't think we'll get there, but they're going to have a lot of copper in the stimulus. Again, will stimulate oil demand and the rest of the commodity complex. And let's don't underestimate the deglobalization, military demand for commodities. So it's all there. Am I confident in the story? Absolutely. We can talk about it later, but there's been some flies in the ointment. One being actually the dollar recycling is absence in this one. And then the other issue is, we have a lot of oil creeping into the system from, sanctioned oil is
Yeah.
another one.
Yeah.
So, but we can talk about those later. But I think the key message here is, I'm definitely still very much bullish on oil and the commodity complex. And the recent, last couple of weeks have been a setback on one part of the commodity complex, but look at the metals. In fact, the one thing we said at the beginning of this back in 2020, copper is the new oil, and that's where the focal point is. But let me remind everybody, the one thing that I learned in that 27 and a half years at Goldman is when one market moves, it's unlikely the rest of them don't move.
So I was going to ask you about that. I want to come back to the dollar recycling because I think that's super important and not something people look at. And one of the things I've always admired about you is you've got such a global picture, right? I think that's important. But let me ask you about copper. The pushback I'm getting when, we've kind of talked about this, that is the worst of diesel demand declines behind us because industrial metals are kind of potentially pointing to that. But then the flip side is everybody's long copper, and that's why copper has gone up. It's actually not a fundamental move.
By the way, there is some truth to that. And that's the bizarre thing about this is, we go back to, let's say, March. People were comfortably bullish oil, gold, and copper. And you asked them what was their number one out of that three. It was invariably copper. But the fundamental story wasn't there yet. Oil, on the other hand, the fundamental story was there. It is still there. Yeah, you cannot sell oil if you were to give it away, yet people will take copper. Copper is a longer term story. We have seen a build in inventory in China that people are concerned about, and we sold off by what 3 or 4% the other day because of that concern, but we're back up again this morning. In contrast, we look at oil. Oil is backwardated. The inventories are low. We have seen an inadequate build this year. But it shows you that sentiment and that momentum that is in copper is continuing to push it forward, while in oil you don't see it there. I just want to make a couple comments about copper that are important for oil. There's a lot of concern about the property market in China, obviously, and recent concerns about diesel demand in oil. So in terms of thinking about the demand coming out of China, is what China has done is replaced its property market as a driver of growth with green capex. Whether if it is in EVs, solar panels, or lithium batteries, there's been a big focus there. It's taking time to readjust that. And that's part of the weakness we saw in 2022 and 2023 was they're making that transition out of property and into green manufacturing. When we think about green manufacturing, it's less diesel intensive than the property market. So that's one thing to keep in mind. But then you have the knock-on effects of the stimulus that this green manufacturing is going to create to the rest of the economy. Once that begins to take hold, it becomes much more positive for diesel. And when we think about the medium-term outlook, we see that manufacturing has likely bottomed everywhere in the world, including Europe. Which will help reinforce diesel. And I think the one thing with diesel and metals demand, because they're both showing, or at least with metals demand in manufacturing, are underscoring this rebound. The weakness that we're seeing in diesel is also being compounded supply from, like renewable diesel, biodiesel.
Just new refining capacity as well.
New refining capacity, exactly. And as I think people are underestimating the potential rebound there. Also, let's not forget, it was really warm in 1Q, which, I like to remind people, diesel and heating oil are essentially the same thing. And so there's some weakness, headwinds there that we think are more temporary.
Yeah, I echo this because, we just got back from China and we've got a big China team as well. And they've highlighted both on the macro side and on the commodity side that there has been a bit of a delay in some of the stimulus, right, coming through, especially Q1. It was expected, but I think the government's ended up spending too much time in the details. It hasn't hit. And to your point, it's that there's a lag, right? So usually it's metals and then, but taking a step back, because you raised this briefly as well, like you've been in Goldman for 27 years and now you've got this new position in Carlyle. Why do you think oil in some ways is hated so much? Because My struggle is I don't disagree with anything you're saying on a medium term level. I get the short term, we've built some inventories, but somehow people are just not excited by oil, whether it be OPEC spare capacity, be it, oh, shale production is going to grow forever. Do you sense that there's just been a little bit, I guess maybe because Russia we just never lost the barrels, people have not made a lot of money. Yeah, it just seems like you said, in March, everybody was still willing to go after copper and not after oil.
But even when they were willing to go after it, like we saw in March, the enthusiasm was a fraction of what it would have been 5 or 10 years ago. And I think it
Exactly.
goes really at the core of the terminal value within the energy equities. People do not see a long-term story here. There is no growth story. It's a terminal value of nothing with a wind down forward outlook. And as long as that remains the case, it's going to be unlikely that investors are going to embrace this market. But the reality of it is demand is charging ahead this year above trend at 1.3 to 1.5 million barrels a day, off of the back of very, very strong growth. Yeah, it was part due to the recovery from COVID in 21, 22, and 23. But I think the key message here is there's no indication that longer term growth story is still not there. I don't want to get into the political debate about whether that's right or wrong, but I think the key message here is there's no indication when we look at this on a global basis that oil demand is really beginning to slow down, even with the penetration of EVs around the world. By the way, the one thing about diesel demand that there has been penetration is LNG
Trucks.
trucks
Yeah.
in China. So there, I'm not going to say there's not penetration,
Yeah.
but the bottom line is we're going through a very rapid global underlying economic growth environment. Oil demand is being pushed further, even with these drags of like
Yeah.
LNG at trucking, and you're above trend. But it's that unwillingness to see the forward. While we take copper, yeah, we're not backwardated. It's not that, we have inventory. It's not, super tight on the front end, but we're willing to buy the copper story because we see the long-term
Right.
benefits, but we don't see it in oil. I think that that's the key reason.
No, I think that's a very good point, and in some ways goes back to what we were talking about, your new position at Carlyle, and hopefully this is the start, right? Because I think more and more people are coming around to this idea that oil and gas will stay here for much longer than expected. But yeah, people need to put the money where their kind of thinking is, right? And the EV story, I will say from China as well, every single Chinese major had gasoline demand in China peaking either last year, this year. Every single one of them is saying to us now, oh, guess what? Now you're starting to see not just EVs, it's hybrid cars that sales are going up because of long distance driving, and gasoline demand is surprising to the upside. So everybody's now starting to push back peak gasoline demand. So yes, and to your point, LNG trucking, I know Goldman put out something around that, but I think their numbers, we've got only 300,000 barrels per day of displacement. I think I've heard numbers of up to 800,000. So our number is lower for the LNG trucking. But again, it's almost even with these headwinds, we are still growing at 1.2, 1.3, whatever that number is, demand barrels, a million barrels per day. So imagine the kind of core demand growth that is out there. It's just somehow I feel that messaging has been lost over the past few years, and it's just gone back to peak oil demand, and yet it never appears.
Yeah, it doesn't. The question, will it appear? I like to go back historically. What's different about our approach to environmental policy today versus, let's say, the war on acid rain in the 70s and 80s is that in the 70s and 80s, policy used sticks, i.e. taxes and some type of penalty for consuming the product that you didn't want people to consume. And then you had the carrots with the subsidies. So far, the approach thus far has been all carrots, no sticks. And we wonder why we're not seeing oil demand contract or, burning carbon and releasing it is outside of a few places in like Europe and California, the sticks, i.e. taxes and some type of, cap and trade approach has not been applied on a widespread basis. And, I like to point out, we have the tools to solve this problem. We all learned it in Econ 101, a negative externality, you hit it with a tax. And I like to point out, we took a market failure, meaning the inability to price carbon, and have now turned it into a government failure with the inability to levy a carbon price or a carbon tax. And
That
so
is the solution.
right, that is a
Yeah.
solution. So until we get to that point, which we have all learned in Econ 101 how to do and how to implement, and we've done it historically on a very successful basis, until we get to that point, I'm very dubious of the ability to see demand really begin to contract.
I think the problem is we all live in democracies and everybody wants to get reelected. So these issues become very, you don't necessarily get reelected if you say energy transition is going to be expensive.
Right.
That's the problem.
Yep. And by the way, when we look at the disinflation that occurred over the last, let's say, 18 months, there's a couple points to keep in mind here. Is one, it happened globally and was very much synchronized. Two, it occurred against the backdrop of record commodity demand like oil demand and against very strong GDP growth in US and China. So was it demand driven? Absolutely not. Did interest rates cause it? Well, if it wasn't demand driven, it could not have been interest rates because interest rates do not create supply. So it had to be new supply. Where did we get the supply? It goes to this point about the willingness of Western politicians to pay for their politics. They were unwilling to push against the sanctions on Russia, Iran, and Venezuela. I did a calculation the other day looking at the U.S. approved $95 billion in aid to Ukraine and Israel, but the turning a blind eye to the sanctions was funding Russia, Iran, and Venezuela another $90 billion like every 6 months. So, on one talking out of two sides of their head, but it goes to the point, unwilling to pay for the politics. The other area, environmental policy. You look at China, India, and Indonesia. The run-up in coal production and consumption was the size of Saudi Arabia. And we wonder why this backs up gas and power all around the world. And also turning a blind eye to deforestation in Latin America for soybeans, cutting down the mangroves in Philippines for more palm oil. So, it was creating supply through turning a blind eye to environmental issues. Even here in the UK, we saw them back away. And then the third point is in immigration, so you got more food, you got more energy, and you got more people, which is the more supply that created the disinflation. But none of this is sustainable.
But my challenge for this year, we think it's a very bullish Q3. Q2, we've now had the sell-off. I think we should be around the bottom here. I don't know what you're thinking. I think we rally in Q3. The challenge I have for kind of recommending, yes, we are going to really go, is we have US elections. And I think you're going to see them, exactly like you said, do anything and everything in their powers, including another SPR release on whatever grounds. It's also become, I think, government policy, or, in the past, geopolitics, we used to always think of it as bullish. Now, politics has almost also become very bearish, precisely because no sanctions policy has actually been designed to keep oil out of the market. And if anything, you've got more and more SPR.
Yep, absolutely. But you look at what drives voters. On the scoring, I can't remember what the magnitude these represent, but economy, inflation get a score of something like 25 or 30. Foreign policy gets like 3. Climate change gets 2. So they talk a big game of climate change and foreign policy, but particularly to the average US voter, it doesn't matter. All that matters is the price of gasoline at the pump. And with that kind of backdrop, yes, they're going to fight the increases in oil prices. And also the part of the reason why people like copper is they go, well, the governments don't care.
Exactly. This is my worry. But do you think then oil goes to 100 this year, or probably not this year?
By the way, the one thing is you get a shortage and you have to clear the market. The ability for this market to pop above $100 a barrel when we were seeing 92 just a few weeks ago, I don't know why people struggle with this. Again, my 27 and a half years at Goldman, the one thing I absolutely learned, always own the wings. The market radically underestimates the upside and the downside. I mean, that's all we ever did at Goldman. They're going, okay, if this thing's going down, it's not going to stop at 45. It's going to go to 25. And if it's going up, it's not going to stop at 90. It's going to go all the way up to 100, 120, and then turn around and come crashing back down. It's the third most volatile of all the commodities behind power, natural gas, and then oil. So yeah, I mean, the ability for this thing to spike up over 100, I think, is very material. And also when we think about what is a commodity super cycle, It is a sequence of price spikes. It's not this steady, no low
Right.
vol rise in prices. It's, the average price rises over time, but the spikes are very large and very violent.
But then what do you say to people who'll say if we go above 100, OPEC's just going to come and flood the market? I mean, I have my views on that, but what do you reckon they
By
do?
the way, I like to point this out with all due respect for the current management, because I do think OPEC management could actually do this correctly. But there is no history, there is no evidence in history going back to 1960 that in the second half of the business cycle, OPEC has ever brought on supply to be able to tame the price spike going into the latter parts of the business cycle. And if they miss by 5 days, they have a problem. Why? Because think about, I'm a refinery sitting in Rotterdam, and I've got, let's say, 3 days of inventory sitting in my tanks. That ship is 5 days away. That doesn't help me. I got 2 days I got to cover, and you're going to bid up the price, and you're going to create extreme backwardation in these markets. And that's ultimately the point here. So unless they're months early, which is very unlikely they're going to be that early, it's unlikely they're going to bring that oil on in time. And again, I'm going to go back to every business cycle since 1960, since the creation of OPEC, they have never done it. Think about what ends these business cycles every time. It's a price spike in oil. And they had the spare capacity to tame it, yet they couldn't. They couldn't bring it on in time.
And especially now with the motto very much being we are cautious, we're going to actually look at all the noise that's coming through. And also a big focus of theirs, rightly so, is this whole SPR, right? How much more SPR do you get? If you do get that, then why should we bring barrels back,
Yeah.
right? It's just becoming more and more political.
And by the way, it's not in their interest to be early. Why do you want to flood the market, create a big inventory build?
Like, why exactly? And this
Yeah.
is the bit I don't understand. A lot of our clients, we had an event here and they're like, look at the balances in Q3. It's the right time for OPEC to bring barrels back. I said, but the decision is on the 1st and 2nd of June, which is before. What if we're all wrong? Just as an example, right? And then why would they bring barrels back? And let's say we have this massive flood of inventory, then they need to cut again to manage that. I think somehow people miss that bit about the OPEC logic, I find, which is fascinating. But let's go back to the dollar, because the points you are making is much more kind of global, right? In terms of in terms of the kind of global financial system as well. Why do you think the recycling hasn't happened this time around?
I think it starts with Russia. Let me ask you, if you're China and you're earning a lot of dollars right now, trade is flourishing. They're long an enormous number of dollars. Are you going to buy U.S. Treasuries with everything you've seen over the last 24 months?
Probably
Not. And we're not seeing those dollars flowing back into U.S. Treasuries. And instead, they're going out and buying things like gold. And it's important. Let's go over what that dollar recycling story would do to oil and commodity prices. You would see that, let's say Saudi Arabia or China were to earn dollars in one of these bull markets. They would take those dollars, put them into U.S. Treasuries. That makes U.S. rates go down. The dollar begins to weaken. A weaker dollar reinforces reflation. The higher reflation and more dollars generated in China and Saudi Arabia would create a credit multiplier outside of the US. And so you'd have more dollars to invest in and consume things. And so it was a virtuous cycle in this dollar recycling, because the dollars would replenish themselves, grow outside of the United States, and create more external demand, which then more stronger growth in China and Saudi Arabia and places like that would weaken the dollar. And so it was that virtuous cycle, and it was particularly important for metals. Less important for oil, but more important for metals. And to think that we're sitting here today, we saw $90 a barrel a few weeks ago, and we saw, $11,000 a ton copper in the context of a dollar as strong as we have right now. You got to be asking yourself, what would these markets be looking like if the dollar had weakened like it normally would over this environment? So if they're not buying U.S. Treasuries, what are they buying? Physical goods. In fact, the announcement this morning, China wants to build a strategic reserve of cobalt.
Yeah.
And they're buying things like copper. They're buying gold, and in particularly gold. Gold is the market that is the most out of whack here. When you look at gold prices relative to real interest rates or the dollar, it's historically diverged at unprecedented levels. Who's buying it? It's China, and it's primarily Russia. And Iraq would be another big buyer of gold. And we don't know what the numbers in Iran. I assume they're big buyers of it as well. But what they're doing is they're replacing the dollar recycling with gold recycling. And, I'm not going to go, I'm not a gold bug and want to get into the implications of it, but it's telling you that the world's changing and we're going in a very different path. I don't know how to handicap oil and commodities for the lack of dollar recycling. But the reason why I'm not going to say it's bearish is because eventually, if they're moving into building strategic stockpiles of cobalt,
physical
it's
commodity.
physical commodity demand.
Yeah. I mean, they're also, from what I've heard when we were there, they're also going to do about 60 million barrels of crude SPR. I don't think that's out in the market, but imagine 60 million barrels of crude SPR in the second half of the year when we are supposed to be tight could absolutely kind of get crude going. Now, they should be price sensitive, so it's not a given that they'll do it at $90 or $100, but you never know, right? Again, China is the other side of OPEC. They're also slow. Once they start going, then they almost become price insensitive, right? If they've decided on the strategic reserves. But what I find fascinating in what you're saying is it leads me to the question we get asked all the time. Do you think oil moves away from the dollar? Like, do you think you basically get essentially oil no longer denominated in the dollar?
We're moving that direction. I mean, if you look at the transactions between many of the BRIC countries and the external, I call the EM space, a lot of this is already being priced in local currency. A lot of the Indian oil that's being sold there is traded in INR and not in USD anymore. Now, does that matter to FX markets? Absolutely not. I like to point out the FX markets between London and New York, it's like $5 trillion a day. The oil market is a pimple on that. It doesn't do anything. And I don't, and for commodities, it's a currency illusion. It's because it's the relative price of the commodities relative to the rest of your basket that actually matters here. So my answer to that every time I get asked that is it's a currency illusion. It doesn't matter. The only way it would matter is if the oil market could impact the FX market, but oil's not big enough.
Yeah. No, I completely agree with you. In which case, say going forward, we pretty much first half of the year is done. If you were recommending trades, which I know in your current position you don't directly do, but put that hat on. What would be your top picks? And you can go not just commodities, you can go any asset class for that matter.
I love commodities in at this point in the business cycle, and let's go over a couple things that are apparent here. Is the one model that we've been using since the 90s with Goldman was this whole idea of a mid-cycle pause. Is that once you see the rate hikes and the higher energy hit the economy, it goes through this period of consolidation to the higher interest rates, the higher commodity prices. And then you come out of the second half of that in the latter part of the business cycle. And that's when you really want to own commodities. That's what we saw at the beginning of 2024. And it's playing out in a textbook fashion. It's just happening at higher interest rate levels than I think people had thought about the past. So this is the time you want to own the physical goods. And your best performing asset classes year to date, when you stack them up, are Bitcoin, which is a physical good, as well as gold and commodities. One point on Bitcoin and gold I like to point out. The rise in the gold market cap this year is larger than the entire market cap of Bitcoin. Gold is the bigger, more established one, but it's the physical goods are the ones you want to own here. Now, which one of the physical goods do we like the most? And the consensus view 4 or 5 weeks ago was gold, copper, and oil, and I still stick with that. They're the ones that have. And by the way, oil is the one that's backwardated. It's the one that's giving you
and the cheapest
it's
the cheapest, right?
Yeah, exactly. But you can't give it away. I mean, you look at its investor positioning, it's running at 14% right now. It's ridiculously low. But I want to go over another point here that people are getting worried about, and they see it, is that as you go into the second half of the business cycle, what happens is the growth rates slow, but the levels continue to grow. And one thing I've been pounding the table on for 2.5 decades is for commodities, it's the level of demand that matters, not the growth rate of demand. As long as that level of demand is above the supply, which we know has to be the case, you did not get an inventory build. Again, the fundamentals in oil are better than copper. There is no inventory build. Well, there's a very small one. I think your estimate's at 33 million barrels. Which tells you the level of demand is above the level of supply. The forward curve tells you the level of demand is above the level of supply. And we're going to see the macro data slow down. And if you still have pricing pressures, and if the Fed is inability where it can't cut, and if anything, it has to raise rates, and I don't want to get into the the discussion around that. the impact it'll have on the financial markets will be very negative. But the physical goods that depend upon the levels. Remember, one way you can think about it, financial markets are driven by expectations. Expectations are driven by growth rates. Commodities, they are spot assets and they're driven by the levels. That's why you get the outperformance of the commodities relative to the financials. So this thing's playing out textbook case, and I don't see it being any different as we go into the maturity of the business cycle, which means you want to own commodities. And which commodities do you want to own here? I'm going to say, oil, copper, and gold. And I may be out on a limb, but I will tell you, if if I knew nothing about the sentiment in these markets and looked at the fundamentals, I'd want to own oil out of those three.
No, I couldn't agree more. I was going to ask you about the Fed rate. Since you said let's not go there, we will not go there because we want you to come back. Let's continue this discussion. So thank you, Jeff, so much. And I will say to all our clients who are going to listen to this, send us your feedback, send us questions. Hopefully we can convince Jeff to kind of come and do this on a regular basis. If you want to send in questions, we'll kind of, try and answer those as well. And we'll get Jeff some hard questions next time. This was too easy for you,
Yes,
Jeff.
it was. But it's a pleasure to be here, and thanks for inviting me.
No, thank you so much. And thanks for listening, everyone.